Welcome to this Killick Explains video, and as you're watching this, we will be very close to the end of the tax year. And a reminder for anyone who's had their head under a pillow for the last few months, that is the 5th of April. So we're in the tax year 2024 to 2025, and that finishes on the 5th of April. On the 6th of April, we'll all wake up to a new tax year. So I've done some videos on the basics before, so I'm going to just run through a final checklist. All right, so this video is my final end of tax year checklist. And basically, some of these things you're going to need to get a move on. At the time you're watching this video, you won't have long left to get these things done, but at least I'm going to try and make you aware of them. So if you have done them, you can sort of tick them off or make a conscious decision that you weren't going to worry about it this year. That's the idea. So let's go for it. And this is going to be fast and furious. At the end, I'll give you some sources of further information. So my final checklist, what's on it? ISAs, individual savings account. Now, I'm just going to go through the basics here. The real basics are you can include up £20,000 per tax year per adult in a standard ISA. You can top it up with a lump sum if you haven't used the full £20,000, and it is use it or lose it. So I'm not saying you must use the full £20,000. You might only want to put in 5 this year, but you need to make the decision by the 5th of April. Okay. Now, if you want more detail on those tax shelters, ISAs, I'll give you a source at the end. This is just a checklist reminder. Fast and furious. Number 2, junior ISAs. So these are ISAs for children. Now here, the annual limit anyone can contribute through a child's parents is £9,000 per child per year. That can be a useful way to tuck away money that is then sheltered from income tax, sheltered from capital gains tax, not from inheritance tax, by the by, and again it's use it or lose it. So if you were thinking about setting up a child in the future, and a junior ISA can be opened from the moment they're born, by the way, you need to get a wiggle on if you're going to use the allowance that is available for this tax year ending on the 5th of April. Number 3, employer matching. Now, this is for those folk who work in a business where an employer basically does a variant of top-up. In other words, what they do is they say, well, if you put in X, we'll put in Y. And sometimes the Y they're prepared to put in can be quite generous because it is down to an employer ultimately to decide how generous they want to be. But here's the point. This is almost free money, or it's crazy to give it away. So have a think about, can I get access to employer matching? Is there a way I could top up my work pension? Now you need to be fairly fast because the 5th of April deadline is approaching, but hopefully better late than never. Now, on to self-invested personal pensions. So these are standalone private pension arrangements, if you like. An employer can contribute. Obviously, you can contribute. More detail in my guides. I'll reference those at the end. But here, you can put up to £60,000 per tax year into a self-invested personal pension. It's then sheltered from income tax and capital gains tax, not from inheritance tax from April 2027, I'm afraid, under a change introduced by Rachel Reeves last autumn, but nonetheless quite tax effective, and what's more, you get a tax kicker at the front end. Again, more details in my guides and previous videos. There's also a 3-year rule. So if you're thinking I've got the relevant earnings to cover this, okay, more about that in the guide I mentioned, then there is a way to drag forward 3 years of previously unused allowances, so you could make a bigger contribution than even the annual allowance appears to permit. Okay. Another thing to think about, another reason to make SIP contributions is if you are fortunate enough to earn £100,000 or more. Around £100,000 up to about £125,000, you start to lose your personal allowance, and to cut through the jargon and waffle, what it means is the tax rate you suffer at that level is pretty brutal. So pensions can be a good way to basically bring your income back down and restore effectively that personal allowance. Just mention it at this point. Then there are junior SIPs, pensions for kids, if you like. Junior self-invested personal pensions. Again, these are long range. You are thinking about setting up your own children, subject to rules changing in the future, or even grandchildren with pensions. Therefore, there are many pros and cons. Okay, the main advantages are tax breaks. So for example, if you put £2,880 in, the government top it up with another 720 to make an annual maximum contribution of £3,600, which can then sit protected from tax, accumulating for a child. Now, they won't be able to access that for a long time. The rules could change, but crikey, that's quite a nice gift to hand on, because we all know how tough it is to save up for life after work as functioning adults. Next, have you got any surplus cash that needs deploying? Interest rates are gradually creeping down. I mean, they might go back up, but they are creeping down. Essentially, you can earn £1,000, broadly speaking, tax-free of interest on cash. So, fine. But if you have a lot of cash sitting around, some people are nervous or they don't naturally invest, and they've got, everything they don't spend goes into a cash account, it gets tax efficient, or what's more, it gets inflation inefficient as well, because most cash accounts don't pay enough interest, even allowing for the tax-free allowance to compensate for inflation. So have a think about, how much cash am I carrying? Do I have more than I need for a rainy day, as we call it? More detail in my guides. Could I deploy the surplus? Try and use up your capital gains tax allowance. Now, this isn't as generous as it used to be. It's only £3,000 of gains from the sale of assets. That's what we're talking about here. That could potentially be sheltered by this £3,000 allowance. Okay, if you have got potential gains above that level, you will be hit with capital gains tax. There are a couple of things to think about that could mitigate it, but you will need to get a move on, given when you're watching this video. One is inter-spouse transfers. You can move assets across to a spouse. That transfer is capital gains tax free at the point it's made, if that makes sense. And then there's a thing called the bed and ISA, which is a way basically you can move assets which would be hit by capital gains tax, okay, were they to be sold, into an ISA. And essentially it involves selling them outside of an ISA, buying them back within an ISA, so that you can then enjoy the benefits that come with sheltering shares, for example, within an individual savings account tax shelter. So again, time is running out, but that's something you could think about. And finally, on my checklist, inheritance tax gifting. Now, inheritance tax is a thorny topic. The rules are being changed by the current government, seemingly at whim, if you go back to last autumn's budget. But nonetheless, you can gift £3,000 every year to the same person. All right. You can also make separate £250 gifts to as many other different people as you like. All right. And then there is the potential to make gifts out of income. Now, what are you trying to do here? What you're trying to do is reduce the value of your own estate eventually, so that whoever inherits it pays less inheritance tax. So £3,000 per year, £250 gifts to anyone else, and gifts out of income, which is gifts subject to a kind of can you afford to make them criteria. Those, under the current rules and the current government, are still safe. So there you have it, quite a long list. If you're thinking, crikey, he skimmed a bit there, well, I did, because it was a final checklist. If you want to find out more, there are other Killick Explains videos. I did a couple just a couple of months ago on ISAs and SIPs, for example. Killick.com/resources for those. There are my how-to guides, which deal with tax-effective saving and investing, for example. There's one with a slightly different blue-coloured cover to go for there. And then, of course, our quarterly magazine, Confidant, regularly picks up on tax-efficient saving and investing strategies.